Hey, it's Dan Zimmerman. Welcome to Illustrate to Educate. Don't forget to like and subscribe to support more simple and objective videos on topics that matter. Also, you can now support the channel directly with the new Super Thanks feature. Have you ever wondered what the difference is between a bear market and a bull market? In this video, we'll look at this so you can understand what's happening in the markets today. First, let's look at what a bear and bull market are. The terms bull and bear are frequently used to describe how stock markets are doing, whether they are depreciating or appreciating in value. In simple terms, a bear market is one that is in decline and is considered a true bear market when it has fallen 20% or more from recent highs. In a bear market, share prices are continuously dropping. This results in a downward trend that investors believe will continue. This belief, in turn, perpetuates the downward spiral. During a bear market, the economy slows down and unemployment rises as companies might begin laying off workers. In contrast, a bull market can be classified by a sustained increase in prices within the stock market, which can be noted in the rising prices of company shares. In such times, investors often have faith that the uptrend will continue over the long term. The country's economy is typically strong and employment levels are high. So where do the terms bear and bull market come from? The use of bull and bear come from the way these animals attack. A bear swipes its paws downward while a bull thrusts its horns up into the air. These actions are metaphors for the movement of a market. If the trend is down, it's a bear market. If the trend is up, it's a bull market. Although a bear and bull market are defined by the direction of the stock market, there are many more things to keep in mind. The first is the supply and demand for securities. A security is a tradable and negotiable thing that has some kind of financial value, usually in the form of stocks, bonds, or options. In a bear market, more people are looking to sell their securities than to buy them. The demand is significantly lower than the supply, and, as a result, share prices drop. In a bull market, the opposite is true. There is strong demand and weak supply for securities. In other words, many investors wish to buy securities, but few are willing to sell them. As a result, share prices will rise as investors compete to obtain available equity. Next is investor psychology. Much of how the markets rise and fall is impacted by how individuals and investors perceive and react to the market, also called investor psychology. In other words, stock market performance and investor psychology are very dependent on each other. During a bear market, market sentiment is negative and investors lose confidence as they move their money out of equities and into fixed income securities. Because they keep their money out of the market, this causes prices to decline in the stock market. In a bull market, market sentiment is positive and investors gain confidence. Investors are more likely to put their money into the market, hoping that they will be able to make a profit as prices increase. Lastly is the change in economic activity. Because the businesses whose stocks are trading on the exchanges are participants in the greater economy, the stock market and the economy are strongly linked. A bear market is associated with a weak economy. Most businesses are unable to record huge profits because consumers are not spending nearly enough. This decline in profits directly affects the way the market values stocks. In a bull market, the reverse occurs. The economy is typically stronger and people have more money to spend and are willing to spend it. Businesses will report larger profits and the value of stocks will increase. So what should you do in a bear market? In a bear market, the chance of losing money is greater because stock prices are continually losing value and the end of the bear market is often not in sight. Even if you do decide to invest with the hope of an upturn, you are likely to take a loss before any turnaround occurs. Thus, most of the profitability can be found in short selling or safer investments, such as fixed income securities. An investor may also turn to defensive stocks, whose performance is only minimally impacted by changing trends in the market. Therefore, defensive stocks are more likely to be stable no matter how the market is doing. These are industries such as utilities, which are often owned by the government. They are necessities that people buy, regardless of economic conditions. And what should you do in a bull market? In a bull market, the ideal thing for an investor to do is to take advantage of rising prices by buying stocks early in the trend, if possible, and then selling them when they have reached their peak. During the bull market, any losses should be minor and temporary, and an investor can be more active and confident investing in more equity with a higher probability of making a return. Both bear and bull markets will have a large influence on your investments, so it's a good idea to take some time to determine what the market is doing when making an investment decision. Remember that over the long term, the stock market has always posted a positive return. Did you enjoy this video about the difference between bear and bull markets? If so, please like and subscribe, and consider donating using the Super Thanks button to support more simple and objective videos on topics that matter. If you like this video, be sure to check out more videos from Illustrate to Educate to the right.